And so you can look at, the Employment Compensation Index, average hourly earnings, the Atlanta Wage Tracker, compensation per hour, basically those four, and many others, and you can look at what they would have to run at over a long period of time for that to be consistent with 2% inflation. They can deviate. Corporate margins can go up and down, and there is a feature of long expansions where they do go down, where labor gets a bigger share toward later in a recession. Later in expansion. So, yeah, and we calculate those, and you have to take the precision with a degree of salt. But I would say that what they will show is that, if wages are running at 5%, 3% is closer to where they need to be. Wage increases closer to 3%, roughly, is what it would take to be consistent with inflation over a longer period of time. By the way, I do not think that wages are the principal driver of inflation. You're asking me a very specific question. I think there are many things. I think wages and prices tend to move together, and it's very hard to say what's causing what. But I've never said that that wages are really the principal driver, because I don't think that's really right.
What the hell are you saying?
I've had a few.
Me too.
All right. Today is Wednesday, the 3rd of May, and this is a review of the FOMC decision today and the conference by Chairman Powell. Folks, I got a good one for you tonight. We begin at our favorite place, the Wall of Worry. What else? Look, I don't know what that was that we saw today, but Jerome Powell was dazed, confused, all over the place, speaking with both sides of the mouth. Maybe this, maybe that, maybe I know, maybe I don't know, maybe we're going to cut, maybe we're going to pause, maybe we're going to raise, maybe we're going to have a recession, maybe we're going to have a soft landing. I don't know nothing about nothing. That's the chairman of the Fed. And at some point, this has to be scary. At some point, this has to terrify market participants and the economy, that we have a Fed chairman who's absolutely clueless. But folks, we'll take it one step at a time. We know what's going on with the crisis in banks. They are collapsing one by one, and today the S&P cut First Republic's credit rating, and they say that the default is a virtual certainty. The bank already defaulted, it's gone. In other words, the S&P is, per usual, of course, Johnny come lately. And then, of course, Citibank CEO came out and she said that she is very pleased that First Republic Bank demise eliminated the last big threat from the banking's recent turmoil. Always so thankful that First Republic Bank took a shot for the team. Oops, wait a minute, more banks are collapsing as we speak right now. We'll talk about that in a minute, but folks, the sad part about all of these regional banks, smaller banks collapsing is the following. All of the money is now rotating in bigger banks, namely JP Morgan, aka the Laundromat. And if you ever did business with the Laundromat, you know that they have the worst customer service ever. If you bank with Bank of America, you walk at the branch and it feels like a time machine. All of a sudden, you're back in the 1970s. Fluorescent lights, old floors, and it looks more like a mental institution than a bank. But then you walk in First Republic Bank or Silicon Valley Bank. For one thing, it smells nice. They have at least a coffee machine. They have places where you can sit. They have nice interiors, nice lighting. The staff is nice. You got good customer service. You feel like you're being taken care of. But with these banks blowing up, now we have to eat shit from JP Morgan. And shut up. Oh, you want to talk about your car lease? We'll keep you on hold for another 4 hours. Maybe we'll get back to you the following day if you're lucky. And that is the saddest part. We, the consumer, will have lower customer service, and there is no incentive at all for BofA or Chase, JP Morgan, to improve customer service at all. What are you going to do? Leave them? Go where? Silicon Valley Bank? Xeon? All of these banks that are about to blow up? That's what we thought. You're staying here, and you're going to eat shit and be happy about it. But of course, the most important event today was Fed Day. Happy Fed Day, by the way. Before the statement came out and before Jerome Powell did the conference, after a few drinks, of course, I was watching CNBC, those crybabies at CNBC, and now they're saying, oh, Mr. Powell, he's raising rates too much. Can't he see what's going on here? Banks are collapsing. All of these banks are going down. The economy is falling apart. When a few weeks ago, they were saying, oh, whoa. Don't sell your stocks. Don't panic. Just because Silicon Valley Bank is collapsing, or I'm sorry, already collapsed, that's idiosyncratic. And all what I heard on TV and CNBC is idiosyncratic. Now all of a sudden they say, oh, it's not idiosyncratic. It's contagious. It's systemic now. Please cut rates. We want the fucking stock market to go higher, Mr. Powell. We gotta get those bonuses. It was a horrible year last year. Our clients might leave. Please pump, print, do something. The problem is we have two sides. We have the ice and fire, the hot and cold, the recession part and the inflation part. And the combination of both is, say it with me, stagflation, baby. And I don't know why everybody has to deny the existence of stagflation, as if it never happened before. You see, on one hand, we have a banking problem. With inflation rising higher, the Fed must increase rates to tackle the inflation problem. And in the past decade or so, there was something called TINA. There is no alternative. You gotta hold your nose and buy all of these shitty, profitless stocks because where are you gonna put your money? Bonds? At zero interest rate? You gotta take the risk, buddy. You gotta buy all of these stocks. And we saw the biggest stock market mania in history. The biggest bubble in history. We've never seen anything like this before. Now, all of a sudden, Tina's dead. She doesn't exist anymore. And the reason is, when the Fed raises rates, you look at the bond market, for example, risk-free, and you look at the 3 or 6 months bills, which I'm invested in right now, and they're paying you 4, 5%. Money market funds now pay 5%. That's pretty good. What is the S&P 500 paying? Not even close. Why would I keep my money in the stock market when I can get 5% risk-free? And this has a negative impact in equities. Likewise, when you keep your money in a saving account, you're getting 0%, 2% max if you're lucky, but you can shop around. You can have your money in a bond that pays you 3%. You can have your money in a note that pays you 5%. In a money market fund that pays you 4.5%. Why would I keep my money at a shitty bank that is paying me nothing at all? And the problem, this kind of thinking impacts smaller banks worse than the larger ones. Because the question is, hey Maverick, why are we not seeing Bank of America, for example, collapsing? Why aren't folks taking their money out of BofA and Chase and moving to money market funds? Well, for now, they're not doing that. For now, people feel that these smaller banks are the problem. They don't understand why for the most part, but in reality, the core of the problem is folks taking their deposits out, whether they feel that the bank is not safe or whether they're chasing something better, a higher yield, for example. The end result is these banks are collapsing one after the other. And the psychology alone makes it systemic. We saw Silicon Valley Bank collapsing. After that came FRC, Signature Bank, and now we're seeing PacWest. Soon enough, it's going to be Key Corp and then Xeon. And who knows? It could get bigger. We could see USB, US Bank Corp, going bust next if this kind of thinking becomes contagious. But most importantly, if alternatives that pays us more become widely available because the Fed has to raise rates higher and higher and higher. And all of what's going on in banks right now, the tightening of credit conditions because it becomes risky for them, they have to tighten the belt. God forbid our clients start to take their deposits out all of a sudden. What are we going to do? All of this is causing a recessionary impact in the economy, and you can see it illustrated in the 3 months versus the 10-year Treasury yields. In other words, this is a massive inversion that we're seeing right now, the biggest this century, which indicates a severe recession coming, number one. Number two, the 3 months bill pays you a lot more than the 10-year note. It's a no-brainer. You gotta take your money and put it in the 3 months. Easy money, high yield. We haven't seen these kind of yields for at least 3 decades now. And we see this recession force working its way in the economy. For example, the consumer is running out of spending power. 73% of millennials are now living paycheck to paycheck. So now the question becomes, if we go back to the crybabies on CNBC, with all of this going on, why isn't the central bank, the Federal Reserve, and Jerome Powell backing off? Why aren't they pausing interest rate hikes? Why aren't they cutting rates to save these banks? Because pausing is not going to do it. They have to cut rates dramatically to make it less attractive to leave these banks. And unfortunately, that's not going to happen anytime soon. And the reason is, we still have that thingy that some of you might forgot about, that people pretend that it doesn't exist. You know, the invisible inflation that we have. And the problem is this inflation, well, it continues to go higher and higher and higher. And every time you think it's going down, it comes back up. Today in the morning, we got results from Kraft Heinz, and it was an absolutely shocking report. And the reason is, the company raised prices on us consumers dramatically. They're passing all of this increase in cost to them all the way back to us, and then some. All of these companies are pushing prices higher. Kimberly-Clark, Nestle, Chipotle, P&G, PepsiCo, Kraft Heinz. All companies, by the way, the Maverick Wall Street happens to own. You know why? Because they got the pricing power, baby. What are you going to do? Not wipe your ass using Procter & Gamble products? You're not going to drink Pepsi anymore? Or Coke? You're not going to do grilled cheese sandwiches using Kraft Heinz? You're going to shut up and pay. And these companies are exercising their pricing power, indicating more and more inflation to come. Now, you could say, if you're watching Elizabeth Warren, for example, she says that the inflation problem is over. And all what's going on right now is companies doing price gouging. And Jerome Powell must back off. The problem is, price gouging is a symptom of inflation, not the cause. But of course, Senator Warren, well, God bless her. Today in the morning, we got the services PMI, and guess what? Activities are revving higher again. Good for the economy, you might say. Sure, maybe, but you know what else is coming higher again? How about prices? Prices are now moving higher again. How can the Fed pause or cut rates right now when prices are moving higher again? Maybe the blow up in regional banks is just the first of a series of collateral damage to come. To take inflation down, to erase a decade plus worth of quantitative easing and easy money, well, normalizing all of that is not going to happen amicably. There will be a lot of victims. There will be a lot of things that will blow up, and the economy itself could come down or become paralyzed. If you recall Jackson Hole from last year, Jerome Powell said there will be pain. Raising interest rates dramatically when they're late to the game to catch up with inflation will cause a lot of pain. And the lesson here is, for future central bankers, you gotta tackle the inflation problem during the honeymoon period of inflation, when customers are flush with cash, when companies can raise prices and no harm done, aka back in 21. But if you wait till the economy gets weaker and it becomes evident that inflation is getting out of control, you're late to the game. And every time you tighten the monetary policy to take inflation down, you're producing more and more damage to the economy. Because the economy now is facing double whammy. One, from inflation wrecking the savings and the spending power of the consumer and raising the input cost of these companies all over the place. And number two, the Fed raising rates and tightening the monetary policy, and money becomes less easy in the economy. And hence the probability of a recession becomes really high. Matter of fact, we have never gotten out of an inflation phase like this without a recession, without the unemployment rate rising significantly higher. But back to inflation. I just want to show you this so you can get a clear picture, because the media is not talking about this. The media tells you that inflation is going down. Bullshit. Here's the commentary by Chris Williamson, the chief business economist at the S&P Global Market Intelligence, whatever. He says, yes, companies are reporting that business is coming back, things are getting better, but however, there are indications that resurgent demand for services is reigniting inflationary pressures. Average rates charged for services are now rising, listen to this, at the sharpest rate for 8 months, as firms report a greater ability to pass increased costs on to consumers. This upturn in the service sector selling price gauge hints at a concerningly stubborn stickiness of core inflation. Here we go. And that comes on top of what? The manufacturing PMI that we got, I believe, last week. In it, it says this: operating expenses rose at a marked and historically elevated pace that was the steepest for 3 months. And the other line says overall output prices rose at the fastest pace for 7 months. Folks, we have many indicators that say that the inflation problem is not over. And If anything, inflation is moving its way higher again. Look at long-term inflation expectations, for example. That went higher in the month of April. The consumer is now expecting more inflation. So this delusional talk about, oh my God, the Fed is overdoing it, the Fed has to back off and cut rates because a bunch of regional banks are blowing up. What do you want them to do? If they back off right now, inflation will come back. We will have a bigger problem later down the road. And effectively, cutting rates right now or pausing rates would be just kicking the can down the road. And again, the longer this fight goes, the more damage the economy will have to endure. And maybe by then we will see Bank of America, Citi, Wells Fargo blowing up. Forget about the regionals. And of course, is the employment market slowing down? Of course not. To remove inflation from the economy, we have to defeat the aggregate demand. Meaning if prices go down, we're not going to see consumers saying, okay, that's good enough, now I'm going to buy. The demand revs higher again and we see prices pushing higher again. Therefore, unfortunately, in every cycle of inflation, the resolution was unemployment, raising the unemployment rate higher and therefore crushing the aggregate demand. Prices go down, folks are too scared to buy because they look around and they see a lot of folks losing jobs. This is not what's happening right now. We got the ADP report this morning and it was shockingly beating expectations. Again, good news for the economy, but bad news because it ensures that inflation will continue to stay with us. Small businesses created jobs, mid-sized businesses, large businesses, hundreds of thousands of jobs. When we look at goods, we know that manufacturing is in a recession right now, so it lost a bunch of jobs, but construction is fine, natural resources is fine, creating over 100,000 jobs combined. And the same goes for services, whether we're talking about trade, transportation, information, education, leisure, hospitality, all creating thousands of jobs with higher wages. That's inflationary. We saw some job losses in financial activities and professional business services, but besides that, the economy continues to create jobs. The demand is still too high. And unfortunately, a lot of folks look at this and say, oh, but Maverick, maybe it's going to be a soft landing. Maybe the Fed can raise rates, keep raising rates to take inflation down, and the economy is going to hold. Did you forget about crying about the banks blowing up just a few minutes ago? Now you're telling me about a soft landing? What the hell is wrong with you? But you know what? You and Jerome Powell think alike. Because apparently the chairman of the Fed also believes that he can raise rates as much as he can to take inflation down. Of course, 25 basis points, one step at a time. Watch the economy get damaged instead of getting the job done ASAP. But of course, he also believes that regardless, we will have a soft landing. Everybody's going to live happily ever after. The man, a lot of folks talked about this today. He was all over the place. He's absolutely delusional, and he has no clue what he's talking about. Deer in the headlights, dazed, confused. So let's pay a visit to D.C. and review the FOMC and the conference by Jerome Powell.
Good afternoon. Before discussing today's meeting, let me comment briefly on recent developments in the banking sector. Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient.
It's kind of ironic and delusional at the same time when he says, the banking sector is stable and resilient. The most overused word in Wall Street right now, resilient. I swear to God, if I hear this word again, I'm not going to tell you what I'm going to do because YouTube has all of these guidelines about violence, and I happen to be peaceful, just like a puppy dog. But here's what's going on right now as we speak. PacWest Bank, that's collapsing. That's going to go kaput any minute now. Western Alliance, you can kick the can down the road. This is going to go down too. Comerica, the same story. KeyCorp, Xeon. They're all going to go down because interest rates are not being cut. And we don't just need to cut them a little bit. They have to be cut by half, more than half. That's not going to happen anytime soon. So either these banks going to pay their depositors more. They cannot do that. They don't have the cash. Or they're going to sit and see their depositors flee away to JP Morgan, to BofA, to money market funds, to treasury bonds. It's just a matter of time. And how long can the economy and the stock market ignore this? My hunch is not for too long. But rest assured, folks, if all of this FUD and bearish talk about the economy scared you away, rest assured the very competent chairman of the Fed, Jerome Powell, says we're going to have a soft landing. We're not going to have a recession. Take a look.
So the staff's forecast is, let me start by saying that that's not my own most likely case, which is really that the economy will continue to grow at a modest rate this year. And I think that's so different people in the committee have different forecasts. That's my own assessment of the most likely path.
Well, wait a minute, Maverick. Why would he believe in a soft landing when we have all of these problems? Well, he says it is different this time around. Now, we're not talking about some Gen Z are gambling on GameStop or AMC. We're talking about the chairman of the Fed. He says it's going to be different this time around. Take a look.
That this time is really different. And the reason is there's just so much excess demand, really, in the labor market. It's interesting, as you know, we've raised rates by 5 percentage points in 14 months, and the unemployment rate is 3.5%, pretty much where it was, even lower than where it was when we started. So,
okay, can somebody please break it down for him? Unemployment is lagging, and the reason is all of these employers, if you happen to own a small business right now, so long as people have jobs in the big companies and they use their credit cards, let's say that I own a restaurant, a bar, business is hot. I get clients coming in, they have jobs at banks and technology companies, and they come to my establishment and they spend a lot of money. I'm not going to lay off my employees right now. But what if they get laid off? The technology companies are laying off employees right now. The banks are laying off employees. And little by little, business becomes slow. And we know that the heart of the economy, the heart of employment in the economy is small businesses. And I'm going to have to get rid of employees when business goes down. But right now, so long as they're swapping those credit cards up and down, up and down, up and down, business is hot. Why would I lay off employees? But that comes later. Unfortunately, the chairman of the Fed does not understand that. Now, the other thing is, you might say, hey, Maverick, I don't care if we're going to have a soft landing or not. Why is the stock market upset about what happened today? If Jerome Powell says it's going to be different this time around, if we're going to have a soft landing, he said that. Shouldn't the market be excited about that at least? The problem is, which Jerome Powell you want to listen to? Because with one side of the mouth, he said soft landing and it's different this time. With the other side, he says, oh, I'm hoping for a mild recession. Take a look.
Having a recession, but it's not that the case of having a recession is, I don't rule that out either. It's possible that we will have what I hope would be a mild recession.
So again, which Powell do you want to believe? Soft landing Powell or a mild recession Powell? And when it comes to interest rates, everybody wants to know when is he going to pause so we can stampede and buy the stock market. JP did not give a clear answer at all. He gave a bullshit, vague answer about additional firming. Take a look.
Hi, Gina Smilik, New York Times. Thanks for taking our questions. I wonder if you could tell us whether we should read the statement today as a suggestion that the committee is prepared to pause interest rate increases in June. And I also wonder if the Fed staff has in any way revised their forecast for a mild recession from the March minutes. And if so, what a recession like what they're envisioning would look and feel like when it comes to, for example, the unemployment rate.
So, taking your question, of course, today our decision was to raise the federal funds rate by 25 basis points. A decision on a pause was not made today. You will have noticed that in the statement from March, we had a sentence that said the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account certain factors. So that's a meaningful change that we're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting.
What does additional firming mean to begin with? What does that even mean? Hey, honey, I think we need additional firming here. It's not working anymore. What is additional firming? Oh, you mean more interest rate hikes? Well, Powell says, oh, I'm going to wait for the data. I'm going to be reactive, not proactive. I'm going to wait for the disaster to happen and then make a decision about interest rate hikes or cuts or pauses or whatever. Maybe we're going to have firming. Maybe we're going to have softness. Maybe this, maybe that. I don't know. And then, of course, with the same breath, he says, but we are at the restrictive level right now. So if we are, Mr. Powell, why aren't you pausing? Take a look.
So policy is tight, and you see that in interest-sensitive activities, and you also begin to see it more and more in other activities. And if you put the credit tightening on top of that and the QT that's ongoing, I think you feel like we may not be far off or possibly even at that level.
So again, a lot of confusion here. And you wonder why the stock market is upset. You wonder why the dollar and bond yields are crashing, indicating a recession coming, because the chairman of the Fed doesn't know what's going on. And then, of course, he says additional firming might happen, and we're going to determine if we need additional firming based on upcoming data. He also acknowledges that the credit tightening that's happening in banks right now will also slow down the economy and perhaps push the Fed not to hike as much as they thought before. Take a look.
Interest rates, in principle, we won't have to raise rates quite as high as we would have had this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted. But that's what we'll be watching carefully to find out.
Okay, so if you believe that we are already at the restrictive rate, if you believe that tightening conditions in banks will add more and more tightness in the economy to the point where you don't need to raise rates anymore, why did you raise by 25 basis points right now? And again, my point of view is he should raise 25 basis points and he should continue to raise to tackle the inflation down, because having the pain right now is a lot better than having pain later on when the economy is a lot weaker. But again, you expect the chairman of the Fed to have at least a stance. Why did you do 25 basis points when you say that we're already at the restrictive rate and banks will tighten credit conditions even more? He doesn't have an answer. Take a look.
Why did the committee feel it was necessary to keep moving?
Well, the reason is that again, with our monetary policy, we're trying to reach and then stay at for an extended period, a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time, and that's what we're trying to do with our tool. I think slowing down was the right move. I think it's enabled us to see more data, and it will continue to do so. So we really we have to balance. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that.
So again, the answer is, it depends on the data. We'll wait, we'll see, we'll assess, we'll look. Maybe this, maybe that. This could happen, maybe not. This is the kind of shit the stock market doesn't like. This is the kind of stuff that the economy doesn't like. Have a stance, even if it is dovish or hawkish. Just have an opinion, for the love of God. But of course, the most important question is, forget about pause. The stock market right now, the delusional stock market that has been blasting higher year to date, is actually pricing in rate cuts. So pause, that's not good enough. The market wants rate cuts. Regional banks, they want rate cuts. So are you going to cut rates, Mr. Powell, or not? Take a look.
Is going to happen? Are you ruling out the rate cuts that the market has priced in?
I didn't catch the last part. Ruling.
Markets have priced in rate cuts by the end of the year. Do you rule that out?
Okay, I got it. So what are we looking at? I mean, we look at a combination of data and forecasts. Of course, the whole idea is to create a good forecast based on what you see in the data.
What about the idea of rate cuts?
Yeah, so we on the committee have a view that inflation is going to come down, not so quickly, but it'll take some time. And in that world, if that forecast is broadly right, it would not be appropriate to cut rates, and we won't cut rates.
And boom, this is the most important answer in today's whatever that was, conference, whatever you want to call it. Verbal diarrhea by the chairman of the Fed. This was the most important answer for the market. He attempted to dodge the question, but then he had to answer it. And he says, no rate cuts. We're not going to do it right now. In other words, Jerome Powell said the obvious that we've been talking about in this channel for a long time. The Fed doesn't cut rates until a disaster happens, be it systemic blow-up or be it higher unemployment rate. So for the market to rally based on the assumption that the Fed is going to pivot at some point or cut rates, Understand the Fed only cut rates if there is a disaster. An economic disaster is not good for the stock market, and hence the hubris and the delusion that we're living in right now. Okay, Maverick, so what are you saying right now? The economy is going to go bust? Everything is going to collapse right now? What is the solution? Look at these regional banks. They're all collapsing right now. We need to rescue these banks ASAP. Do you have a plan? I do. Would you like to listen to it? Because it involves Taylor Swift. Yep. I don't know if you saw her recently, but she can fill stadiums. We're talking about 60, 70, 80, even 100,000 crowd capacity. And for those fans, to them at least, she's God. Whatever she says, whatever she preaches, whatever she does, she can't do anything wrong in their eyes. Whatever Taylor says, it goes. And you know what? It's getting to her head now. She probably thinks that she's God now, with the muscles flexing. I mean, how could it not get to your head? You have all of these people, millions of people worshiping you. You're probably going to think you're God too. But the point being here is that Taylor Swift is an economy herself. She can revive economies from the dead. She comes to Vegas, all of a sudden Vegas tourism revenue goes back to pre-COVID levels, as if the thing never happened. Thank you to Taylor Swift. And I say now that the Federal Reserve spent about, $300 billion in propping up these zombie banks, and it's not working. I say, how about the Fed hires Taylor Swift? Or we pay her, $500 million to do a public message. Don't take your money out of your shitty regional bank, otherwise you're not a true Swiftie. How about you keep your money in this shitty regional bank for another 6 months, and you get a free ticket to Taylor Swift concert? How about she do a song about how great regional banks are? You really think people are going to take their deposits out of these banks in defiance of Taylor Swift? You're going to leave the regional bank that pays you 1% interest rate and move your money to a market fund that pays you 5%? Shame on you. You're not a true Swiftie. And boom, problem solved. Deposits are not going to flee these banks anymore. And we did the job with a fraction of the price. You think I'm joking, right? I'm not. You got a better idea? Because these banks are about to blow up right now. Time is ticking, and there is no practical solution. The Fed will not be able to cut rates. If they do, it will be a massive mistake. If you got a better idea, let us know in the comments. And with that, folks, we have reached the conclusion of this video. Hope you enjoyed it, and if you did, return the favor by subscribing, pressing the like button, the notification, you know the drill. But folks, this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.
I think that's my glass.
Oh, I'm absolutely certain of it.